Good afternoon, everybody, and welcome to the Revolving Loan Funds and Loan Loss Reserves and Other Credit Enhancements webinar. My name is Sam Kramer. I am NASEO's newish program manager working on financing the energy water nexus and our state planning guidelines. And I want to welcome you to the first in our series of Financing 101 webinars. These webinars are designed for state energy officials and staff who are beginning to learn a little bit more about finance, and who are also, or who also could just use a refresher. We are going to be going over several different topics of existing and relatively new financing methods here. So to really help kick us off here with this is a really great jumping off point. We have two great speakers here today who are going to be talking to you about loan loss reserves and revolving loan funds. We've got Matthew Brown on the line from Harcourt, Brown and Carey. Matthew is an affiliate of ours. We've worked with him on several initiatives. He has a lot of great work. He's going to give us an overview of revolving loan funds and credit enhancements. And then we have David Bracht. He's the director of the Nebraska Energy Office. He's going to talk about their dollar savings and loan program. It's a really excellent program that's done a lot of great work catalyzing energy efficiency in the state. Before we get started, just a couple of quick rules here. Again, if you're called in and for some reason your microphone is coming through on the audio line, please mute your microphone beforehand. And then what I'd like to do now is I'd like to take roll call by state. So if we could start, if I could get states A through L, please, to announce themselves on the line. How do we do that? Well, apologies, folks. This is my first time working with GoToWebinar, so I'm used to doing these in a different format. So I apologize. We'll get attendance at the end of the session. So I'd actually at this time just like to turn this over to Matthew. Matthew, are you there? Hi, Matthew. Can you hear me?
I can hear you.
Okay,
can you hear me?
Loud and clear. Yes, we are good to go. All right.
Okay.
All yours. Sorry about that.
Okay. Yeah, no worries. Okay, great. Well, thank you, Sam. Appreciate the short introduction. And what I'm going to do here is really two things. One is I'm going to offer a kind of brief introduction just to kind of level set, make sure that everybody's on the same page as far as vocabulary and basic differences between revolving loan funds and credit enhancements and some of the basic features of those. Then for the last section of the my talk, I'm going to review some specific examples and offer some observations on some of what we have seen from different revolving funds and credit enhancement programs, and a little bit of a sense of some of what the states, what we see states encountering, and some of the issues that states have encountered, and talk for a little bit about what kinds of solutions we see various states coming up with. So very quickly, trusting that everybody can see my screen, I always like to start out with the famous Admiral James Stockdale quote. If you don't recollect or know who he was, just think back to the time when Ross Perot was running for president, and he was the unknown figure who appeared on the vice presidential debate and started out with the famous line of "Who am I and why am I here?" Just very quickly, our firm, we focus on establishing, developing, refining finance programs for states and utilities. We are an affiliate member of NASEO, have worked with NASEO for years and years. I personally have worked with NASEO and with states for essentially my whole career. So love working with NASEO folks, and we've worked with a bunch of states on establishing, refining, developing various financing programs, so listed here. So into the meat of it. And this is a part I'm going to run through the next 15 or so slides relatively quickly. Again, this is kind of a level set, and then we'll go into more detail on some of the experiences that we've seen with different states. So, first off, just thinking about what the heck is financing? Financing, the easy part of financing, it's a means to get money from a capital provider to a customer. That's the easy thing. I mean, you think about it, that's what rebate programs do, that's what grants do. The hard part is maybe the more interesting part about financing is that it also involves getting money back from that customer over time, right? That's where financing is challenging, involves a whole bunch of regulatory structures and so on, but it's also the magic of financing because it allows for sustainability. When you think about financing, the first thing you really need to think about is the capital provider. In other words, where's the money? And if you're a state energy office, typically what we see is that there are state energy offices that are still using petroleum violation escrow funds, PVE funds, various types from over the years. We see various types of federal funds, EECBG, SCP formula, SCP competitive, SCP ARA money. We see money from state agencies, other state agencies that energy offices are involved in, environmental agencies, just to give you a sense there. We've been talking with folks from Oklahoma recently, and the energy office there has been having discussions about possibly working in collaboration with the environmental agency that has money from what's called a state revolving fund, which is largely focused on water. Sam mentioned his job is the energy and water nexus, and financing this is a perfect example of that. But essentially, that energy office is looking at coordinating with the environmental office in the state to develop perhaps some type of more collaborative financing arrangement or financing plus grant arrangement for energy and water. Greenhouse gas funds, a lot of innovation we see in states that have that appropriations and ratepayer funds. And so there's a pretty big variety of kind of where the money comes from. Maybe the more interesting question, though, is when you start to dig a little deeper, thinking about whose money are you deploying, what is the real purpose or mission associated with that money, and this is the kind of thing that really starts to drive how revolving loan funds or credit enhancements are used, and especially as you start to think about what are some of the requirements that come with that money, what's the risk tolerance of that money. So, for example, we have seen there's a general trend that we are seeing now where a number of states are looking at their SCP ARA money and some of the reporting and other requirements that have come attendant to that, and they're trying to think about whether they want to continue to comply or not. They're not going to not comply, but continue to run loan programs in the way that they have in the past because of some of the reporting and other requirements that are attendant to SCP ARA funds, whereas those same requirements may not be in place with SCP formula funds, and even fewer kinds of requirements are in place with PVE funds. So each money that you have is going to have different types of requirements that are attached to it. These are the kinds of things that really drive the loan programs and what works. Here's an interesting thing. I'm going to provide some examples as we go through. But the state of Michigan was provided with money that had been ratepayer funds that were collected by the State Public Service Commission and then used to provide a credit enhancement for a loan loss reserve, which we'll talk about in more detail later. That's an example of a state that has had money that with a great deal of risk tolerance, not a huge amount of money, only about $6 or $7 million, but a great deal of risk tolerance. So they were able to use that money then to leverage other kinds of money. So just giving you a couple of examples, different types of capital that exist. Now, thinking briefly about what it means when you're running a revolving loan program, or when somebody else is running a program that you are credit enhancing. So we have capital providers, we have customers, we have money flowing. At some point in this phase, somebody has to create the legal contract that establishes the structure under which a borrower is going to repay funds. And that entity is called the originator. And the originator really takes on a variety of roles, right? So that originator takes in that financing application, underwrites the application, might pull credit scores in the case of a residential loan program, might file liens, documents the finance instrument, and most importantly, that finance instrument is going to have to comply with any applicable laws and regulations. If any of you are familiar with and have kind of watched some of what's happened with residential property assessed clean energy, or PACE, you may have seen that there have been some lawsuits recently which have been working their way through the courts, and in some cases have been actually dismissed at an early stage. But some of the elements of those lawsuits were that the origination had not been done properly and in compliance with the proper rules. The point here is that, especially when you're dealing with residential, but frankly, when you're dealing with any type of loan instrument, where essentially you are obligating another party to repay funds over a period of 3, 5, 10, 15, 20 years, that instrument has to be done in compliance with all the applicable regulations. And that is not a small piece of work. Finally, the who originates question. Of course, you can have a variety of originators, ranging from states or utilities to financial institutions, or even some third-party originators, and then we'll talk about that in a couple of minutes. Who manages the flow of money? And so this is as money is flowing back. The servicer, a servicer, is the entity that is in charge of essentially billing that customer, invoicing the customer, making sure that all of those invoices are done in compliance with applicable regulations, tracking the flow of funds, reporting on the flow of funds, complying again with appropriate regulations, and also dealing with collections and charge-offs and delinquencies and defaults. So again, the same types of entities can originate, can be states or utilities, can be traditional financial institutions, or could be third-party servicers. If there's a trend that we are seeing now, it is a trend away from states or utilities actually doing origination or servicing directly, and outsourcing in some cases those services to third parties, or, as you're going to hear about from Nebraska, engaging banks, or in some cases credit unions, to do this origination and servicing. So what we've been talking about are the kind of operational elements that are involved in running a loan program. So just to kind of, again, level set, we're talking about two things here. We're talking about revolving loan funds, and again, I like to, just to put this up here. This is a pool of money lent to customers, customers of the administrator's choice. Loan proceeds always used to pay for energy efficiency retrofits, and repayments of those loans are then plowed back into energy efficiency. So one of that's in contrast to energy efficiency loss reserves, which again are a pool of funds, but in this case they are set aside as a third party makes loans, and in a sense you can call those funds kind of a loan insurance, right? They're covering possible loan charge-offs. Typically, what we see is that as a loan is made, say a $100,000 loan is made, if there's a 10%, there might be 10% of that loan amount set aside into a separate account. And then if there's a charge-off, typically what you'll see is that say 90%, sometimes 80%, sometimes more, sometimes less, of the charged off amount is then reimbursed to the lender. So it's in essence it is a way to get lenders to lend in markets they would not otherwise lend in. So now, take all that together and you think about the various roles that one can play, and what are the roles of government. And option number one, I guess this is in the kind of revolving loan fund area. I guess I'll call it the whole banana. In other words, government does everything from provide the capital to originate to service. This is kind of the traditional revolving loan fund role, but I would say we're actually seeing some kind of a trend away from that, especially as governments are kind of looking at where they can best play in this marketplace, and the fact that in many cases originators and servicers are available who have specific expertise in doing this. What we're seeing then is often in revolving loan funds, governments are actually acting as a capital provider, letting a third party do that origination and servicing. And so that's a kind of a trend that we're seeing more and more of. Another kind of a variation on a theme, often, or in some cases, you will see the government is providing some of the capital. So you're going to hear about, from David, you're going to hear the Nebraska model, which is essentially that. You have a government providing some of the capital for energy efficiency lending, but in coordination with and then leveraging private capital to increase the total amount of capital that's available. Another type of, another variation here is what we call a warehouse. This is government providing some of the money for just some of the time. So typically what you might see here, this is a model that the Connecticut Green Bank has used, where Connecticut's Green Bank, essentially you had a pool of $20 million that it used for a residential, a commercial property assessed clean energy lending facility. They lent out those funds and held on to it for a short period, and then essentially sold off a good portion of that $20 million to third parties, and essentially then replenishing their funds. So that $20 million acted as a warehouse, and then most of it then was sold off, and they held on to some piece of it, and so that was an example of I guess using public money for some of the money for just a little while, I guess. Moving to the loss reserve kind of structure, what we talk about here is you have a third-party capital provider, and none of the government money is used to directly lend, but that money is instead used as a backstop. So if a loan goes bad, if a loan goes into a default and charge-off status, at that point, that third party can apply for reimbursement of some portion of that charged-off money. So Michigan is a great example of a loan loss reserve type of program. California is has set up and is operating loan loss reserve types of programs that will entice third parties to come in with better loan terms and rates than they otherwise would have available. And finally, in terms of options, there's the rate buy down. The rate buy down, again, there's no money that's government money that's invested. There's no money that's put at risk. However, government money is used in this case to reduce an interest rate by 2 to 3%, 4%, 5%. So there have been programs. There are programs in Massachusetts, for example, that offer a buy down of a market-based interest rate from the market-based rate down to a 0% rate to encourage customers to do energy efficiency. Been some very successful programs that do this. So thinking to contrast loss reserves versus revolving loan funds, this is kind of my view of where these fit. So a revolving loan fund, in my view anyway, is something that can provide loan funding where the private sector will not do so, and often that's very often in the case of hard to reach markets. Maybe it's more rural markets, maybe it's loan sizes that are too small for typical, maybe it's new technologies. So often I see this as not replacing the private market, private sector, but supplementing and providing funding where it's maybe not necessarily available already. A loss reserve instead of providing funding, it supports funding where private funding might be willing to be active, but only at what I'll call unattractive terms. So to give you an example, what we saw in Michigan, the private sector had been offering unsecured energy efficiency loans for 12 to 15%. We came in with a loss reserve, and we were able to get those terms down to less than half of that, and actually even declining from that point, less than half of that amount, with longer terms than had otherwise been available. So that's the purpose of a loss reserve versus a revolving loan fund, in my view. Capital needs, loan funds, you need to have all of the lending capital available. Loss reserve, you're getting leverage. So you're getting, maybe it's up to, typically 10%, 10 times, but maybe up to 20 times, 5 to 20 times kind of leverage of private sector capital. Operational, in a revolving loan fund, you need to have either on staff or hired expertise in the origination and the servicing of the loans. You've got to have, versus on a loss reserve, you have to have staff who are available to evaluate claims on that loss reserve and then disperse those claims. So in both cases, you need to have staff on board who are either supervising or actually perform these operations, and you need to have those staff on board for the life of those loans. One note, I mentioned rate buy-downs. That's kind of more of a one-time kind of thing where so you don't actually need to have that operational staff in place. Giving you a couple of examples, I mentioned Michigan on in a couple of cases. There's a loss reserve program, essentially paying 80% of the charged off amount up to 5% of the total registered portfolio of loans. So, think of it, if you have a $10,000 loan that's amortized down to $6,000 and it gets to a charge-off state, there would be $4,800 that would be paid to the credit union in this case, using this, originally this was from ratepayer money. So they've had very good good performance in this program, less than 2% charge off over the 7 years of the life of the program. Couple of examples, Wisconsin, Colorado, and a bunch of other states, but they have had commercially focused revolving loan funds. In this example, both supported through SEP-ARA funding with quite a lot of initial participation. The interesting thing has been, in both cases, there have been some concerns about headline risk, about how to deal with defaulted loans or charged off loans. It's been kind of an ongoing concern that these two states have had. Nebraska, I'll just mention only to say that you're going to hear more about it, but it's kind of a hybrid model that I think is very interesting and worth looking at. So what do you end up in terms of practical effects of a revolving loan fund? You often, we have seen revolving funds where companies that are in I'll call it the valley of death stage, in other words, where they've maybe created, model number one, prototype one, they've moved to early commercial prototype, but they don't have the ability to develop, say, a piece of a wind turbine that's particularly efficient and new to the market. They don't have the ability to do that. So in Wisconsin, for instance, some very successful loans were made to get companies over that valley of death stage. Residential, you might have homes that are might not otherwise be able to receive loans due to poor or maybe even non-existent credit history. So we will see that. So notice that here, these are loans that might be made to people who the private sector might not otherwise loan to, right? And then sometimes you'll see revolving funds used for smaller public entities that where simply, there's no available private sector funding. Sometimes because private sector funds will not be willing to lend in the smaller amounts that say a small school district might be willing to. Bank of America, for instance, will lend public sector customers money typically if it's a $2 million loan or greater. So there's a big space below that where state revolving funds might really fit in. And of course, a lot of revolving funds are done for the purpose of job creation. Loss reserves, typically what we see loss reserves providing longer terms. So where typical lenders will go to 5 to 7 years, we'll see loss reserves getting terms out to 10 years sometimes a little bit more than that. We see rate reductions often in that 1 to 2% kind of range, and we've seen that pretty typically. The only variation or the kind of issue I would say here is keep in mind a loss reserve benefits a lender when the lender charges off a loan. A lender is not going to see much benefit from that type of loan insurance in the highest credit tiers, right? So the loss reserve is probably going to tend to benefit customers the most who are in kind of lower credit tiers, because that's where the charge-offs are. So you can sometimes see some variation depending on the quality of the credit that people are lending to. And we've seen definite periods where examples of lenders coming into markets that they wouldn't otherwise come into. So the last kind of point I'd like to make is just kind of think through, broadly, what are we seeing in various states? What are some of the trends and barriers that some states are seeing with their revolving funds in particular? We've seen some states that are seeing very little loan volume in some of their programs. So just as an example, we've worked with Oklahoma, where there were 5 different loan programs, one of which was producing some decent loan volume, but a lot of them simply were not producing much volume. When we went in and spent some time looking at what was actually happening and looking at the loan programs that were being offered, in many cases, or in some cases, it turns out the private sector loan programs were actually better, largely, I think, because the Oklahoma loan programs had been developed, a fair number of years ago, and they hadn't really had the opportunity to really make big changes to those programs. So one of the things I think is always looking and understanding what it is the private sector is doing, not only now, but also continuing to do that over a period of time. We're seeing states that are dealing with administrative burdens, too few staff turnover, trying to deal with reporting requirements, trying to deal sometimes with servicing, collections, defaults. In some cases, we've seen some states where they don't really have a good idea of what's happening with the performance of their loans, or if they do and loans have gone into default, they haven't really been able to follow up with customers very effectively, and sometimes that's leading to charge-offs. And I think so. One of the other issues that some states have dealt with is how do you deal with charge-offs, especially as a state agency. Some states are not necessarily equipped to deal with a kind of delinquency and collections process. So one of the things that states can look at is a couple things. One is establishing a credit policy. So looking at establishing from the outset a robust credit policy that's going to be used to underwrite loans on a consistent basis. And we've seen even an organization as large as the New York Power Authority really didn't have that, especially as they were going into new markets, really didn't have a strong credit policy. So we were able to help them to develop that. In addition, we've seen some of these things can be addressed through loan documentation. In other words, looking at the types of loans that you have and that loan instrument, and is it a robust instrument that has a robust mechanism to enable or to be very clear about repayment policies over time. So Another kind of trend that we have seen is that in some cases markets have changed. With some state revolving programs were set up originally with PVE funds, which have been, which go back quite a few years. Markets are changing, private markets are changing. So I think, it's important to be able to do a kind of a gap analysis occasionally to understand, what it is that your state, what markets your state is actually operating in. And then the other thing that's interesting, we've seen, Iowa, for instance, has recently had a whole variety of loan programs transferred to it, and as of October is going to have a whole series of new loan activity that's going to be coming. Some cases it's the opposite, but I think often we are seeing states that are starting to really more and more deal with some significant changes in either funding availability increasing or in some cases decreasing. So this maybe gives some sense of some of the trends that we're seeing overall. And I think in many cases, I think it's a lot of these issues are, there are fairly straightforward ways to deal with them. I think one of the interesting things is also looking at, what some of the examples are from from a variety of other states. Using NASEO as a good way to start to understand what different states are doing. So, a couple of concluding thoughts. I think it's important. Lending isn't as easy as simply giving away money through rebates. You have to understand those risks. There are significant benefits to it, but it's something that you really need to make that you're understanding. Lending from whether you're doing a loss reserve structure or whether you're doing a revolving loan program, you need to really understand what the private sector is already doing. Don't set up something that competes with the private sector. Figure out a way where those gaps are. Figure out how to best use your limited public funds to bring in the private sector funds, and figure out also think hard about what your own resources are, and I don't just mean financial resources. I really mean, are you a 6-person energy office? Do you, what ability do you have? Are you a larger energy office, but do you actually have the ability to do, loan servicing, origination, and so on? And if not, it's not that you can't do the program, but think about what other some private outside resources you can use effectively. So I'm going to stop there, and I know David's going to offer a Nebraska example, and hopefully have some chance for questions after that. Thank you so much.
All right, well, thank you so much, Matthew. Really appreciate that. I'd like to actually we have a little bit of time here, so I want to do a quick Q&A session before David starts, if that's okay with you, David. So I just want to open the floor really quickly to any questions anybody may have for Matthew at this time. Hey, Deb, we have a question coming in from, hey, Matthew, we have a question coming in from Oklahoma, from Rhonda, who says, what would the credit policy include?
Hello, Rhonda. So a credit policy is basically looking at the specific market that you are lending to and establishing the criteria under which you are going to lend to a customer. So that would mean, in the example of a say a municipal lending program, offering we're establishing a credit policy that would say we will lend to municipal governments or to school districts that meet certain criteria. For instance, a strict credit criteria or policy would require that you only lend to rated credits, right? So in other words, credits where an outside third party has provided a B or whatever it is rating to that third party. Or you might say, and that actually would be pretty strict and Or you could say we will only lend to, in the residential sector, we will only lend to customers who have, say, a 640 credit score or better and a 50% debt to income ratio or better. So it's a credit policy is basically establishing the rules under which you're going to use to allow people to borrow money. And then it may also be related to how much money you allow people to borrow, and may also require just different levels of documentation. So for instance, you might say under a certain credit score, we will require people to provide proof of income, that kind of thing. So there's a variety of elements, but it's the filtering or screening criteria that you're going to use for whatever market that you are entering.
Great, thank you for that, Matthew. At this time, I'd like to just, in the interest of time, turn this over to David Bracht from Nebraska, who's going to talk about the Revolving Loan Fund program. If you do have questions for either Matthew or David, feel free to either send them through the questions box, or you can raise your hand and I'll make sure to unmute you. So David, are you there? Hi, folks. Just hang on just one quick minute here.
Sam, can you hear me now?
Sorry about that.
Okay, thank you.
We had you on mute for a second, but we're okay now.
Okay, and it appears to me that our screen is up, so if you can confirm that just before I get started.
Yes, you are good to go. Sorry about that.
Okay, no worries at all. Thank you so much. Well, first, just to reintroduce, so my name is David Bracht, and I'm the director here at the Nebraska Energy Office. I maybe have met a number of you, maybe many of you, but and it looks like we've got a good group on. I also have the rest of our team here, both Aaron Miller and in particular Jack Osterman, and I'll be referring to him later because through the now longer than 25, actually I think we're into year 27, Jack actually was involved in the organization and development of of Nebraska's dollar and energy savings loan program. I'm going to go through it pretty quickly. Really, this is intended to kind of just do a drill down on one particular model of all those options and different features that Matt talked about. And really one thing I particularly clued on that he mentioned was understanding what the private sector and what the state office capabilities were. So that first bullet up there, it's work with Nebraska chartered lenders, and that's really our participant. That's our channel into the marketplace. And as Jack was developing the program, and he had, before working at the Nebraska Energy Office, had actually worked in the commercial banking sector. And so I think that gave him, and then the whole program benefited from his really awareness and understanding of both what it took to have a loan program, what the private sector could do, and then what role we in the state could do. And the tagline that I like to use a lot is, our program has been as successful as it has because we have the right people doing the right things. And in particular, we rely on the bankers to make the loans. And we'll show that a little bit later on here. The program itself is focused on, really covers a broad range of potential energy efficiency and waste minimization measures. Those are a few pictures there. People that are eligible, individuals, businesses, and local governments, and we regularly make loans to all of those, or participate in loans to all. And I'll highlight the distinction there in a moment. To give you an idea of the scope, both currently on an annual basis and over the history of the project, in our fiscal year that just ended in June 30th of 2017, the Nebraska Energy Office portion, we participated in 280 projects, and our portion of that was really leveraged with the loans from the individual banks, was $5.9 million loaned. Altogether, the energy efficiency improvements last year was just under $13 million, and the total, that was the total energy efficiency improvements, and then additional aspects of those projects that weren't eligible really for including in the loan would have added about another couple $1 million. So we over the history of that, looking at the now 27 years of the program, a total of just under $350 million of improvements, of which the Nebraska Energy Office portion of that has been $166 million and over 29,000 projects. So for a program, I'll get into the size of it, but I think we've had a pretty significant impact of that. And as those pictures indicate, it does cover a wide range of both things that would be larger energy efficient, renewable energy, such as that solar panel array, and solar projects as a single category were probably the largest last year. I think we had a total of over $3 million of Nebraska Energy Office funds that supported just under $6 million of solar energy loans out of that. So of that $5.9 million, just under $3 million of that was in solar projects. And I think that also reflects the fact that obviously, or I say obviously, but in fact here, even just a few years ago, and definitely not 10 and 15 years ago, we had no solar loans. So the project, because of it, the way it's structured, I think has been able to adjust to the things that are needed. To get into how the program works, it really is supporting a revolving loan program, and from that standpoint, the part that Matt made, that the funds that come in are how we replenish the fund to allow additional loans being made. The original, today it's capitalized at about $48 million. The original capitalization was $10 million from PVE funds or funds from the oil overcharge funds. We did have some additional contributions that came from PVE funds, some other different sources within the state. And then within the last several years, as Matt mentioned, had about $11 million of ARA funds that came in as well. One of the things, and I think an aspect that both we're very proud of, and candidly I think makes our program very easy to defend, is that we have a very low loss ratio. We are subject to some losses. If a loan goes into collection or there's a bankruptcy, the bank is responsible for undertaking the collection activities, but we're really last out once the loan goes into collection. But because of the way the programs have been structured in our work with the banks, that's been a relatively infrequent event. And periodically we'll have a situation where we do have a loan or a bankruptcy, but overall that roughly $150,000 over the history of the program. And obviously that's a very low rate. Any of you that are familiar with the banking industry, and I had a conversation with my counterpart on the governor's cabinet, that has the Banking Financial Services Department, and he asked, what was your loan loss ratio? And I gave him the 0 point. He said, stop. If it's 0 in front of the point, you're way ahead of what almost any other program would be. And again, the key to it is that loan pool is revolved 6 or 7 times. So that $48 million, that's how we're able to continue to make those payments. What I think is probably, if not singularly unique, very close to that, is the fact that our program is a loan participation model. And in that structure, and our program, we implement it through Nebraska chartered financial institutions or lenders. That could be a Nebraska bank, a state bank that's chartered here, or a national bank that's organized here in the state. And we do but with both, but also credit unions are also active participants in our program. And it is those institutions that are actually making and promoting the loans. And for Nebraska, in particularly, I think that also allows our program to be used really statewide. And in fact, I think in the rural areas gives it good exposure, because it becomes another tool that the rural bank can use. When someone comes in looking for a loan because their furnace needs to be replaced, or they want to replace windows, or they want to put in a solar array, this is a way for that rural bank to offer a very competitive interest rate. And in fact, the bank takes care of all both the origination and the servicing. Where we get involved then is for those qualified projects, we purchase somewhere between 50 and 90% of the loan. And that's a very standard banking kind of a transaction. We're entering into a participation agreement with the bank. And under that participation agreement, we share in the principal payments, but we don't take any interest on our share of that loan. So to look at it differently, let's say that a $10,000 loan was being made to replace windows in an older home, and that'd be something we see fairly frequently. And right now our rates are at 3.5%, but easier math at 2.5%. The customer is viewing it as a 2.5% loan. We would buy 75% of that $10,000 loan. So the bank makes a $10,000 loan to the customer, and then we turn around and buy 3/4 of it, essentially giving to the bank $7,500. At that point, the bank has $2,500 invested in the loan or outstanding. And when the customer makes that 2.5% interest payment, it's essentially then all going to the bank, and they're able to make that market rate of loan. Some of you might say, well, geez, that means the bank's making 10%. That sounds like above market. But ultimately, the bank has then a pretty small loan. And to be able to service that loan and operate that loan, so they've got essentially a $2,500 loan outstanding. Each year, they'd get $250 that has to take care of all the overhead for that. That's not an unreasonable thing, and is probably what's needed to get the bank to cover their expenses on it. The other thing that makes it very easy and important is that we have set up 8 predefined categories, plus there's a do-it-yourself, which we really get involved with in doing the energy efficiency evaluations, and also our Energy Star 5-star plus homes, which is a home home that's built well above the state energy code requirements. But the key to the program's success is those 8 predefined categories. So that loan officer knows if I can get, and there's forms that are set up for each one of those categories, that loan officer out in a small community in Nebraska who doesn't maybe make a whole lot of these loans, he knows, well, if I have a customer that comes in and they're looking at new windows, all I have to do is make the windows, make sure that they meet the guidelines that are set, and the instructions and all the information is on that website there. And so it is something that the bank can easily do. Jack works very hard to not make the program be a barrier to use, and I think that's a key thing. You know, and we're an energy office. In an ideal world, we'd love to have an energy audit and a whole lot of other things. Those would have been things that would have been barriers and would have reduced our ability to make those. However, we have at different times under that kind of do-it-yourself, that analysis, really do some different things that really do allow us to look at specific programs, and we've done a number of things that are larger, either for municipalities or a variety of things, schools, etc. One more substantive slide here. This really shows kind of the flow of the funds then. So at the top there, you see the borrower asks the financial institution for the loan. First step is, does the lender want to make a loan to this person? And they do that before they come to us. And again, I think that helps to that low default rate. We're not getting involved in that. That bank is doing what it does every day, is making loan decisions. They commit the funds to the project, but none of the project doesn't go forward then until we receive the application, the other materials to approve the loan that it in fact qualifies. Once it does, then the borrower makes whatever improvements they're making using those loan funds, and we go through and we purchase it. When the bank extends the loan, actually gives the $10,000 out that I mentioned, that's the point where we'll purchase that participation. When then the borrower pays back that loan, the financial institution keeps the interest, and we share in that principal on a pro rata basis. And the loan payments go back to fund new loans in our revolving loan process. So that's really helps us to have administrative staff, is largely focused on managing and saying, are the forms being filled out completely? Are we getting the information? Does it really comply? Our state energy engineer gets involved in those to the extent it's looking at the actual improvement. Is it meeting the requirements? I would say in solar panels, there ends up being a lot of that. With windows and things like that, it's quite a little bit easier just because of the way those programs are set up. I did mention it is a broad range of programs, and one would be the energy efficient housing loans, and that is one where our state energy engineer here gets involved quite heavily, because he has to approve those home plans. And it seems that those loans seem to kind of come in surges. I know that we've had 3 or 4 loans just in the recent, I would say, last 6 to 12 months, and those are, generally pretty high value homes. So those are loans that quite often the $300,000 or $400,000. Other loan categories beyond the ones that I've just mentioned, which the HVAC systems, windows, rooftop solar. Also, we've done loans on CNG, compressed natural gas powered vehicles. I've done some significant work there. And then in recent, if not months, years, doing work with some CNG fueling stations, some geothermal systems. Had a school district that we put a pretty significant geothermal system in. And then a little bit longer ago, but very significantly, Jack, this predates me, but Jack worked through with the Nebraska Medical Center and did a very significant, actually used a master lease program through our loan program. And altogether, it was about $2 million of energy efficiency investments. That was combining not only our loan, $5 million, well, $6 million. So it was that's right. Okay. So it was $6 million altogether. The $2 million comes up. So it was about $6 million of total investment that the University of Nebraska Medical Center implemented. Some of that was ARA funds. Pretty significant amount was the master lease that we did with the Nebraska Medical Center. And that $6 million of improvements today has a return that they tell us, Nebraska Medical Center, about a $2 million a year in energy savings from that $6 million investment. So obviously got a really good return and a good education for the Nebraska Medical Center and frankly the regents, because then when they built their most recent fairly significant expansion at the medical center, all of those energy efficiency improvements, the variable rate pumps and fans, flow meter things, all of those things were implemented in the new building as well. We weren't involved in that, but the medical center and the regions who approved those things could see the significant benefit that those improvements had. And so I really like to use that as an example where our involvement early on has helped to have a more significant impact down the road. So with that, I guess I'd be open for questions either for me or I'm sure Matt.
Great, David. We actually do have a couple questions that have come in while you've been speaking here. The first two I'm going to give you back to back because they come from Tim Leach. Tim asks, did the loan write-offs come from a particular project type or borrower type? And does NASEO charge any administrative fee on the loan participation dollars lent to financial institutions?
So it was largely residential, and I think what we've seen there, we've not, I'm looking at Jack, I don't believe we've had any commercial loans or significant loans. And so I think what that loan write-off reflects, when we do write off the most recent one I can have my memory of working at, it ended up being like a $4,000 write-off. It was a loan that probably, if I'm remembering right, started at $12,000 or $16,000, had paid down for several years, and pretty standard in the banking business. Some loans, somebody gets in trouble and they end up filing personal bankruptcy. So that's really how that loan write-off has happened, mostly in residential, to answer that question. And Sam, help me on the second one, quick.
The second one was, does NASEO charge any administrative fee on the loan participation dollars?
Thank you. So the answer to that is no, but that is where our SEP formula funds have been important. That's been one of the aspects that we've used our formula grant funds over the years as part of the support for that and really establishing our overall.
Great. And then the next question comes from Carey from Pennsylvania. She asks, how did you grow the fund to $48 million if you don't keep any interest? And about how much of the fund used for NASEO support staff?
So again, the original 10 million then was supplemented, and I think in the end, the original 10 million of oil overcharge funds, we had a couple of more contributions that probably totaled the oil overcharge to 25, if I'm remembering correctly, and Jack's confirming that. We had $11 million of ARA funds, had a couple of other, and have a couple of other contributions from some utilities and things that are one-off, that the details don't matter. And then another thing that a bank does, and that we have to really manage it, essentially being a bank, is we always have some unloaned money, because if you don't, then you're not in a position to be able to make new loans. Now, those funds that we're holding, when they're not invested in a loan, are earning interest. And that was during the time period, starting in 90s, where there were some times where we were able to earn more interest than we've been able to now, of course. So, and at any given time, I think right now we're about $36 or $37 million of loans outstanding. And so we have about $10 million on a rolling basis that we've got available to make loans. And so that amount of money is earning interest as it's held by the state, waiting to make loans each year.
Great. And is any and about how much of the fund used for any of the support staff? Did you answer that part?
That's none of the fund is used for that. The SEP formula fund, and the interest on the loans is on that, not on the loans, on the unused funds, the uninvested funds is what supports that.
Great. And then finally, we have a question coming from John Seawall asking, this is for Matthew, what types of capital providers offer the highest leverage for LLRs?
Probably credit unions at the moment would offer the highest leverage. I think you have to look a little bit more closely at the particular market that you're going after. And so I think you're probably going to see the highest leverage currently coming out of the residential market lending, as opposed to commercial, or as opposed to, say, multifamily, which probably has the lowest leverage, or as opposed to tax exempt lending. So, I think the place where you're going to see the most, the best leverage is going to probably come from credit unions. We've seen in Michigan, which was set up with a 5% or 20-to-1 loss reserve. That's was done entirely with credit unions.
Great, thank you. Well, at this time, we are out of time for our allotted hour. So I want to say thank you so much to both Matthew and David for two tremendous presentations. There's a lot of information, and I hope this helps out. And of course, you all are all invited to join us for our next webinar. The webinar will be focused on on-bill repayment and on-bill finance, and that will be taking place on a Thursday, September 28th from 2 to 3 p.m. Eastern Time. So we hope to see you there. We'll be sending out a reminder and a registration link shortly. Thank you so much, and everyone, and have a great day.